The NASDAQ has a long history with terrible breadth, but what does this mean when it comes to us as traders and investors? Today we investigate 50 years of data and talk about the 1, 2, and even 12-month expectations that we get from those reads. It's actually quite interesting. The other thing we need to talk about is demand destruction leading into the FOMC meeting. Yes, the biggest monthly event is here, along with Apple earnings later on this week, and of course the non-farm payrolls, jobs numbers. But with one-day VIX charts spiking as we expected the day before the FOMC, does this lead to further volatility? Today we talk about the structure leading into it and what some of the biggest hedges may have to do that could give us insight into the next big move. Stay tuned. Let's get into it. Well, welcome back everybody to the Daily Show where we discuss stocks, commodities, and cryptos. We've got an amazing session today because we'll be talking about the FOMC in our prelude to that. The macro data are going on right now with the NASDAQ. And of course, we'll also be talking about the key charts later on with our technical levels that we should be looking at. If it's your first time here, welcome to the community. Subscribe and smash that like button if you find value in today's video, which I'm sure you will. We've got a lot to cover. So let's talk about the Fed. It seems that they're probably going to do the rate hike and then most likely pause. We've seen the stats. It's like upwards of 80 to 90% of economists believe that we're going to get this 25 basis point hike. And then the question becomes, how long is the Fed going to pause for? People are looking for certain words and also tones, and we know that's the most important thing when it comes to all of these statements. If they mention the word cut, well, that would be a surprise. But they're more likely to mention something about firm policy if appropriate. So something like the committee is prepared to firm policy if appropriate, and that would signal basically they're going to pause the markets. And there's not going to be any more hikes. Now, this is what people are interested in. And of course, the dot plot is something that we'll be looking at in the future. But this is how it looks right now. This is basically the committee members and what their expectations are for the Federal Reserve moving forward. Now, we've seen all of this before. The market has a different idea. Of course, the market's yield looks like this. Bunch of cuts sitting like that. The Fed, however, is sitting at, we're going to hold firm pretty much above 5, maybe no rate cuts for 2023. Then we'll cut in 2024 when appropriate, and we'll start leading it down. It's this difference between what the bonds market or the market itself is saying and what the Fed is saying that will become probably the most important aspect of the next 6 months. And we'll discuss that later on in today's video when we look at the bank or the actual balance sheets here for Federal Reserve and central banks around the world. This is the most important thing to follow if you're an investor. Pretty much significance is key. Let's talk about earnings. Again, demand destruction is coming into full force. AMD's stock is sliding after the earnings, and the numbers didn't look too good. Chipmaker overall margin influenced by big drop in profit for the key data center group, as well as executives' forecast is the key here, which is basically not looking too good either. It's very similar to what we've seen now in other consumer discretionary style stocks. So really we're seeing demand destruction in play due to the fact that it's finally getting through. All those Fed hikes are starting to put the pressure on the economy. In our previous video, we discussed this, which is the one-day VIX options. And this is a CBOE special, and they've backfilled it all the way back in the history. And what we were able to do is realize that the day before, if we came in with really low volatility, we were generally going to spike up. That's exactly what occurred. The thing, though, with most of these events is we're seeing incredibly big suppression straight after it. So often we might spike up into it, continue through part of the session, and then by the time Jerome Powell's actually speaking, VIX is dropping heavily, and then all of a sudden we're seeing a rally in markets. We'll talk about that in just a second, but yes, that first spike from the VIX one day certainly worked. In terms of complacency, it's pretty real in the markets right now, and there is a reason why. We know that this FOMC looks like it's not very volatile on the surface, but it's partially due to hedging. So this is an S&P 500 forward volume curve as it sits right now. So basically we have the FOMC event, and this is well over a standard deviation away from the normal median or mean levels that we usually see when it comes to vol curve hedging. Basically, a lot of players are hedged heavily, and if they unwind these hedges, the first initial move, especially if it's down, may be unwound by a huge rip due to these hedges coming off. And if that does occur, then we need to be aware of that. It's the first move that we'll be interested in, and we're going to be specifically looking for traps. This is probably the most big thing coming into non-farm payrolls, FOMC, and even Apple earnings this week. Understanding the trap levels is going to be the most important part of being flexible when it comes to trading. From an investor standpoint, as we said we'll do on this show, we're going to talk about the 3-month to 9-month and, of course, the longer term. I always remain the same on the longer term. I do think we'll get through it, pending, of course, we never go into a Great Depression. I very much doubt we will. The Federal Reserve during the Silicon Valley Bank crisis basically said, we're going to bazooka the market at all points. And I explained this on our Monday live stream. I really suggest if you can, subscribe to the channel, go back, watch the first half an hour of that, and I go through each 3 scenarios because, of course, they're totally different depending on whether you're a swing trader, an investor, or, of course, more of a scalper and day trader. Each one of these is slightly different depending on the events. Here's the VIX 1-day, and you can see the spike going up. It's still nowhere near the volatility of the previous events. These are all CPI events pretty much and FOMC events. So you can see there's still room to grow in terms of volatility coming through. And we'll look at the S&P 500 chart a little bit later on. But let's begin by just discussing a couple of things that people are talking about. Sell in May is, of course, a seasonality concept. This is a 10-year chart just showing that sell in May really wasn't a thing. We got that initial drop in the start of May, followed by a rally. Now, that's the last 10 years. It's due for one because it used to be one of the most classic seasonality trades. Here's what happens if you go over 25 years. And over on Twitter, I posted what happens over a 95-year period, which you'll see is why sell in May was a thing. It really did drop through that period, and then we saw the pickup. Will it be part of the overall longer term statistics? Well, price action will dictate that, but we do need to remember that theoretically, yes, if we go over 90 plus years of history, sell in May is a thing. It just hasn't been for the last 15, 10 years. Now let's go into some data before we look at the central bank liquidity, because of course, central bank liquidity will be key before, after, and over the next coming days, specifically around what is going to happen. Are they going to support the markets? Are they going to do some trick in the back end? We will be following that on the channel, so make sure to subscribe. Let's go through the NASDAQ long history of terrible breadth. It's no secret now. Most people are pretty aware that breadth has lessened. Basically, it is 10 stocks this year that are holding this market up. If you look at, say, something like the US 2000 and you were short that this year, well, you've done fine. If you were short the NASDAQ, not so good. If you were short the S&P, it's been sitting in a massive channel for a while, maybe like 200 points wide. So basically, we have totally different market conditions. And let's have a look when we've seen similar reads here of the NASDAQ composite after a 3-year low and its cumulative advanced decline line. It doesn't look very healthy, at least initially. Obviously, the long term looks really good. In fact, the statistics look very bullish for it when you look at it overall. But there have been about, I think it's like 9 downs and 20 ups. So that's worse than the normal statistics. Overall, this is usually a little bit of an initial negative read, and it's in line with some of the things we've been talking about with a rocky next couple of months in the markets. Here's another read here in terms of the advanced decline line. Again, you'll see some weakness, especially through the first couple of weeks. Long term, sure, 12 months or medium term, it does look usually positive, but the stats come in line with kind of peaking off. You can see a few of the points here that we do have often show us we've peaked and we're going sideways. Only a few have been driving higher straight after the report has come out. Let's also talk about demand destruction with our data. We brought this in on our previous videos. I just want to keep remembering it because it will come important when we talk about energy later on. Suddenly, Goldman downgraded some energy stocks. And this is surprising because, well, not really surprising at all, but we've seen this before. Demand destruction is fully in play, especially through metals and commodities. And I've been mentioning this to the Australian viewers out there recently that I believe the ASX was hot and it was going to cool. And that's because of copper, which we'll look at soon. Look at these commodities charts, though. Very negative over the next 6 months when we get readings like this. Not a huge data sample, but still there. If we go through the below 35% here, negative 15.8% correlation with this only happens 11% of the time. So pretty rare statistic. and again leads into pretty poor results across the commodities. We're seeing the same thing in agriculture. It's all dropping, new lows being formed through here, 9-month lows. When we get reads like this, agriculture tends to be very poor. Look at that, 29% 6 months later. These are some pretty bad stats. So with that taken in mind, what are we looking at? Well, the Fed's job is starting to play out. Basically, what we thought before, which was that all of these rate hikes would eventually cause demand destruction, which is what they're trying to do, is happening. We're seeing a slowdown of the economy, and it's no more present than XLY, consumer discretionary, which we'll look at later. We have literally a tale of multiple markets, but it really is the big tech stocks that are reacting to something we'll talk about when we go through central bank liquidity soon. Here's an update to smart money versus dumb money flows. Remember, it's just a concept. We use it along with other confluence techniques. Smart money kind of bought a little bit recently, but very, very small still, nothing to note. And of course, dumb money is still floating around at these highs. Does that mean anything? Well, it can help to really make sense of a situation should we get the right triggers on the markets. And we'll talk about them later. Fear greed index coming into the FOMC is completely neutralized, so nothing new there. So let's talk about the balance sheet. Now, this is one of the updates to the balance sheet. Basically, this is the problem with the markets right now. The Federal Reserve has come through. Of course, if we look at the bear situation in the macro, when we sold off in the middle of Feb, that was a pretty solid sell. We obviously saw a huge amount of FOMO in the markets. We wiped everything off the gains of this year, and then we moved down. Then the Fed came out with the bazooka. Now, when they did this, they basically said, again, all of that credibility that they were trying to build, saying, oh, we won't support the market, there's no Fed put, whatever, they suddenly basically took that away. And what this shows is that in the future, they will come back in. It's always been a thing. We know it's broken. We know they'll have to come back in. And the market is kind of calling their bluff in this situation. They're saying, look, politicians and other things that are outside of your abilities are going to force your hand to continue to pump the economies up. And of course, that's really the bull case right now. It's literally central banks saying, hey, we're going to support the economy, creating, of course, asset bubbles in the main stocks, of course, being tech. And I want to be well grounded here because, again, I'm taking some of your feedback on board. My medium term is still bearish because we should theoretically see the dot plot move towards basically holding. If they hold and the market is wrong and the market is actually not going to get what it thinks, the market will crack it, especially when you have this purple line here, which is central bank liquidity kind of tracked across a whole bunch of different things. A lot of explanations in there, but basically it's showing you a divergence here. Now, when we've had this in the past, we haven't been able to ignore it. A swing trader or an investor looks at this and says, oh, that's not so good. Here's what happened with, of course, Silicon Valley Bank. And of course, we were bullish up until these points here. Over this point, you've started to get that kind of sideways. And now we're seeing a discrepancy between the current market conditions and where the taper is at, where effectively the pullback of the central bank liquidity is. If this chart goes like this, well, of course, you'll have to give up on bear concepts because the central banks have attacked it again. However, I don't expect that to occur. So I think we'll be following this chart a lot more. Of course, we'll be bringing it up here on the channel, so subscribe and we'll cover it in as much detail as possible. Another thing that I've mentioned since the beginning of 2022 and realistically for a long time now has been forward PE. If you're an investor and you're looking for value in markets, you've really got to consider, don't worry about PE, it's a waste of time. Markets trade 12 to 18 months into the future, yeah? And of course, economists all come out together and then decide what they think is going to happen. And they're probably wrong partially, but still it's one of the better reads you have. Forward PE over the average of the S&P and over the average of a sector that you might be looking at is still a very important factor. And at the moment, we're seeing it in the middling zone. So it's not really cheap, nor is it expensive. And I've said this for a while. If you see it in the cheap side, well, it can be one of the many reasons that you might say, oh, I like this market right now. And I think that's something that's very important to look at. Is it cheap right now? No. Is it expensive? Slightly. Are some stocks a little bit more expensive than others? Yes. I mean, that would be in tech. But the bargains could be actually in the Russell 2000 later once we see a turn moving in the markets. If we actually see a proper recovery that isn't just driven by 10 stocks, then we could actually, you're never going to miss an opportunity is what I'm trying to say. You have to have patience, and you might like Apple, you might like Microsoft, and I love Microsoft, don't get me wrong. Every single, I don't trade it for a reason because I just like it and I think it's the best stock in the market. However, the way that I look at it is you've got to realize that it's all about really focusing in on, is there another opportunity somewhere? During the 2020 pandemic, if you missed the first tech run, oil was the best performer of the next 12 to 18 months. Finances did very well. There's always another opportunity, yeah? Let's talk about the markets moving forward in terms of earnings. AMD has just reported, bad for it, down about 6-7%. Actually in line with what the options market was thinking. Of course, that's the general move. Apple is coming out here on Thursday, so be aware of that. And let's move over now to the rotation we've seen in recent hours. So it was a day of semi-defensives here. We had consumer discretionary flatlining because it had been sold off so much the previous days, which we'll see soon. Then we have XLP and XLV, which are two defensives, healthcare and staples sitting out in front. Energy got bashed the most with the downgrades, and also just in general, I think demand destruction starting to play out. Very cool charts on energy charts. We've talked about it before last week. It was one of my strong plays. Obviously the concept here of commodities and demand destruction, I think, is one of the strongest plays that we've seen in markets recently. We've got here consumer, obviously technology and communications being the best 5-day average. Utilities and other defensives kind of settling around the middle to the lower side, and consumer discretionary, it's just up. But geez, I tell you what, considering how much Amazon was up and then it went down, overall it is flatlining across the board, and we'll see that very soon. Let's jump into the charts now and talk about all of the key levels. We'll kind of fly through a few of these as we talk about the FOMC event. First up, we've got here the equal weighted S&P 500. And the equal weighted S&P 500 realistically shows us a kind of, pretty negative side of things. I mean, obviously we breached through this high and we close above there now. We're probably moving towards 150. So that would be in line with some S&P 500 we look at soon. But you can see there's actually a small change of trend here. When we got back up into this level, we suspected there'd be sellers, and there has been on the equal weight. So the equal weight does look kind of negative. In some ways, people will be calling some of these things evening stars. And they're a decent pattern, and they're on the S&P 500 and everything. But I think the FOMC will override no matter what. NASDAQ versus the NASDAQ equal weight. You can again see how there's just a couple of companies here driving up heavier. When that's happened in the past, it hasn't really been positive with the markets. It's tended to lead into some negativity in the middle term, which is the next 1 to 3 months. And that's in line with some of the data we saw early in today's video when we went over 50 years of history. Consumer discretionary versus staples. This is effectively 1/3 of the US economy. It still doesn't look very good. It's usually you see consumer discretionary versus staples come with you in these rallies. So if you go back through, you look at the 2020, oh yeah, it was back on. You look at 2008, you can really see that nice pickup here in consumer discretionary versus staples, and it ran the entire period. When you go into these sideways points, generally that is a weakness in the market, and we actually saw slowdowns over 15, 16, and of course we saw slowdowns over that 18 to 20 period as well. So I always like looking at this chart, and it does show you that the market's kind of sniffing out that there is a lot of weakness here still, but they're betting on Fed support. And that's where the question is, will Jerome Powell stick to the plan? Will he actually do what he says and say, I'm going to actually learn from history and stick to the dot plot? If you're a bear, you need him to stick to the dot plot. That's the big thing here. And I just wanted to, again, just discuss that with the community. That's at least one of my main clarity positions when you're talking about it. And yes, of course, I still remain bearish over that period of time. Let's talk about the VIX here. Volatility did spike. Usually speaking, the VIX has been very good with, seeing like a 30, 35 VIX has historically been a pretty good time for market kind of bulls to come out and say, well, maybe now is an opportunity. We haven't seen a big spike since the first quarter. You tend to see Q3 usually be the next big spike. We are coming into a volatile event week, but I think it's being suppressed a lot by 0 DTEs. So the VIX, not as much as it was. Let's move over to copper. This is a chart I'm watching heavily over the next week. So this is going to be a big one. Will copper finally break through these lows and move into this critical little box down here. If copper fails down here, let's say it actually closes below down here, this 3.7 level, then we're probably in a bit of trouble, especially for markets like the Australian market, and we'd be in trouble for a lot of those oil, metal stocks in general. Demand destruction full in play at that point. And look, it's been in line. We've discussed copper for a while. It's been a pretty good instigator of this type of stuff. And recently we saw that kind of break that looked real, and then all of a sudden it just slammed back down, got the nice close, didn't break above, and yeah, it's been on since then. So that's really where iron ore and other stocks started to move. US 10-year dropped, obviously bringing up treasuries and stuff. This will move quite a lot, maintain pretty much 3.3 is the key level here. I would suspect the Fed come out and probably hit the, if I was to guess, I would say they probably hit the we'll use policy if needed, but we're going to kind of let it simmer for a while. So effectively say, well, we think we've done enough. We're going to sit there and not hike for a little bit, and then, but we may do it if appropriate. So that may hold the US 10-year in a tighter range, or at least the US 2-year in a tighter range, as we find out what's going on. US dollar, this one here, look, it tried to get above. It's coming back down. We mentioned in the previous video that if it does breach this trend line, which it has, that basically drops may be met by buy demand. I could see it kind of coming in around this 101.30. This area here may provide some structural buying for the dollar. I'm not super big on the dollar into the non-farms. And here's the other one. Of course, gold went up heavy when yields dropped across the board. We saw big drop-offs on yields, and then all of a sudden gold loves it. Well, yeah, gold does really love, I've said this before, the correlation with yield dropping and gold is pretty strong. It came off, this is now the most heavily traded zone. So it came off this trend line that I've no doubt been weaker on recently. I remained neutral, and I still kind of do remain neutral. This is a fairly decent close though. So to get above 2015 is a line I've looked at for a while. And I kind of believe now that maybe drops might be met by some buy demand in the short term. I'd be actually looking for it to come back down into the heavily traded zone again to see if it can react there, and then maybe get, you know, a nice turn for day traders. Not too much on the horizon though for gold. I wouldn't be surprised at all for it to get slammed back down. Obviously, if it closes above these highs, well, we'll reassess gold at that point. It could be on a new breakout. But this is a nice closure above, and you can see on the daily, it actually cleared all the wicks. So that's a fairly strong one. It gets past all of these long leg dojis. The problem is really the news, and that's why, just for me, it was just neutral. I was just chilling and waiting for further events. At the moment, though, gold on the short term looks towards the bull side. On the medium term, I'm kind of negative on it, and on the, which is, you know, 3 to 9 months, and on the long term, I am bullish on gold. Let's move over here. US oil, what have we got going on? Still weak, looks terrible. I don't think there's an actual trade here for me. It's just like more of a continuation. If markets do pull back up, you'd probably expect in here for sellers to recommence. But this line here, oh, it got so close. That was going to be an exceptional sell. But as I mentioned in other videos, my real sell for energy was stocks, and it came through big time over the last 24 hours, 4.34%. We actually saw ZOM as well. If you have a look at Exxon's chart, very nasty looking chart. I wouldn't be surprised at all for some rallies, but overall this is a pretty negative chart. You get here some false breaks to the upside, basically a Wyckoff distribution at this point. You can see it's broken through. If we go down to something like the 2 hour, you can see there's a lot of extra volume that came through with this, which is the earnings, and then all of a sudden it's sold back off that level. So you've got a gap up, you've got a gap down, you've got an island reversal across a lot of energy stocks, including the index, and a drop. So I'd kind of expect rallies to be met by sell demand across most of these energy stocks, regardless of how everyone's been so bullish on them. Obviously, I turned negative a little while ago. Tesla, let's move over here. So another fairly poor day for Tesla. It held up pretty well considering. Both Amazon and Tesla were holding much better than the rest of the market, and that's because I think they were sold off so heavily recently. That's a pretty bad candle coming into it. It's still not above that white line. If we get above the white line and we close, I feel like we're probably going towards 180. That would probably mean the markets are getting above that 4220 zone and moving towards 4300, 4350. If we see the markets, where they are right now, we have to just believe they're going towards these gap fills. And I still maintain that 120 is very possible for Tesla. So we've kind of got possible return points here for both of them. And yeah, I mean, look, nothing looks super good for it. If it hovers again and then suddenly you get that gap up though, remember this would be a gap down, gap up, reversal. You should see some nice momentum trades. So I'm open as a trader. You've got to be open to both sides. I think both sides are available here on Tesla, and we'll see how it plays moving forward. Nvidia finally got a day of short in, not huge short, down 2.42%, still pretty good. It came up to this box that we're looking for the reaction. Actually gave an exceptionally good little entry point on the smaller time frames into the close of the session. If you'd shorted it, well done to you. It has left a gap behind now, which you can see on the charts here. And I think this is going to become important for FOMC event stuff. And we'll talk about that in a second. The initial reaction to the FOMC events has often been the wrong one. So we've seen it go off in one direction and then boom to the other direction, or off in one direction, then boom to the opposite direction. This is fairly common in news. And if it does occur, then you've just seen potentially a trap. So it's all about that idea of we don't really want to predict too much into these events. We instead want to react to it. We need to understand, though, what might be happening on both sides to kind of get a better idea of it. Apple overall still not in the extreme level, no turn of trend, no real sign of significant weakness. Obviously, it's just a down day. So we'll come back to that as we get the earnings reports. ASX 200 for the Australian viewers out there. Look, it's pretty much exactly what I wanted to see. It's down pretty hard, which I thought it would be. And yeah, we got that nice switch. So I'm very happy with this. It actually hit first targets for me. And next thing is, and into the FOMC, that's pretty nice. If copper fails, though, expect the ASX 200 to also continue to weaken. So is this a buy zone for the ASX? No structure yet. Just fell off and is basically sitting here in the day. You want to look for daily closes. How have they closed? Those types of things, weeklies, etc. It's swung underneath all the stop losses that would be here, though. So there's a potential buyers may recommend. It's not strong enough. It's not replicatable, in my opinion. Let's move over to Rio. This is something that we've been talking about for a while. It's just an iron ore play, just to show you the power of that copper stuff. Here is the turn. That's the short day. And of course, it's going down. I still think there's more in Rio. It's not, I've kind of explained this to somebody recently. Unfortunately, it's not always like a Russell 2000 or an S&P 500 that is the best trade. Sometimes it is other markets, and I'm particularly fond of sectors. Obviously, if you've been watching the channel, you'd know that. So yeah, in this case, the iron ore is looking still very weak, and I kind of feel like the first stop could be in here, though I have a suspicion it may even go lower down to the 96s with rallies being met by sell demand. Copper will be one to watch, though, for these iron ore plays. Let's move over to the DAX. Now, on the surface of it, pause the video, chuck in the comments, what do you think that looks like? Because you may be correct. It really does look like it's a Wyckoff. And this is where the market's getting super sneaky. Take a look. We've got a lot of weak purchases here, which is usually demand. We have false break, question mark, at this point. And of course, we know that this market is, at a pretty big peak here. Now, we've seen this play out before with this one over here, where we got that break up. It sold off, and actually went down fairly hard. Then roll reversaled here and came off this little block that sits in there. So that's what it came off last time. This doesn't exactly look strong, but if it does beat out this level and close, it's probably going to squeeze at that zone. So you've got to think, yeah, on the surface of it, this looks weak. FOMC is going to be very important to it. We'll come back to it. IWM at massive critical levels. This was the best short, in my opinion, this week in terms of markets. This was what I had. You can go back and watch the Sunday video or whenever I put it out. And basically, that was the level that I liked the most. This is a very good short zone, very replicatable, really excellent. Good target zone here in terms of the way we look at technicals, big daily close, significant level here. And if it closes underneath, rally should be met by sell. And it may be the actual internal signal that the markets are actually going bearish. So I do think that we've got a lot at stake here on the Russell 2000. And we'll be watching it. But look at the return for this year on the Russell. So this is December. That's all the run that happened in January, completely wiped. So see how it's the story of many markets. We'll look at that later on in videos, but this is totally different to what many people think. See, a lot of people, when you're talking about bearish action, if you just like tech stocks and the big tech stocks and you're just looking at NASDAQ or S&P because of that front load, you'd be like, this is the year. And yes, it is certainly going very well. But the actual internals of the market look disgusting in comparison. It's like literally two stories, and it's kind of bizarre. It's almost never been like this in the past. And that's what makes it such a tough market. You know, so someone like Stanley Druckenmiller, who's pretty much the best investor of all time, he's come out and said, even himself, that this is the most confusing he's ever seen in his life. But I think there's one thing that's very interesting about whenever you're talking to any of these people, and they always say the same thing. Unfortunately, we've come and we've learned to expect the Federal Reserve to come back with this money. And the market is definitely calling the bluff right now of the Fed. So I still think the Fed will stick to their plan. They will beat inflation, and hopefully they don't let peer pressure, which is what social media and everybody else is doing, to allow them to deviate from killing inflation. What do you think, though, in the comments down below? I don't mind healthy discussion. We can always talk about this stuff, so see what you guys think. Let's move over to the NASDAQ. We got, of course, a big kind of reversal here that led to a new high. That new high may have trapped some money. We've obviously had this box here for a long period. We've got theoretically what looks like a weak market, but it did rally into the close. And when we look at the S&P 500 in a moment, you'll see what I mean. US 100, again, there's the rejection. That's where we're sitting. Roll reversal. Certainly could rally here, but let's look at the S&P 500. The first sign you'd look at, you should say, well, it's not really a gap up, but it certainly moved up. And then, of course, a gap down. So is that a candle sell? On the surface, yeah, you would say that looks pretty weak. And it's starting to really play out in a way that you could make good candidate of potential distribution. Do we have a break low? No. Would a bull be scared yet? Probably not. And the reason is going to be really about where it closed, which is basically the daily 20 moving average. So it closed right on that level. And that just so happens to be that heavily traded zone we've been talking about. So basically the market went waterfall down. Then it came straight back up and closed in here. Now, we were in the the actual public community. I was just posting around. We actually got a 1 minute switch in here. Well, you can see it on the 3 minute too. The 3 minute switch in here, which happened after the waterfall. If you bought there, well done to you. Very nice trade, very replicatable, exceptionally good take profit as well, sitting around these heavily traded zones. So I think that's a good zone for you. If we go to the daily, now I've just added, this is not a great indicator, but it's a pretty popular one. You probably recognize it if you used it before. Basically, I think it's the lazy bear squeeze indicator. And it actually just got a little switch. So you can see it went to the red side. Now, the only reason I bring it up is because for the S&P 500 recently, it's been relatively accurate at not giving false switches. So it's interesting that now it's starting to say, well, maybe we're actually seeing the pain trade to the downside. So that's the first sign there. But let's get away from an indicator for a second because we don't usually use them too much and understand what the scenarios are here. So scenario one is just an initial move that's in line with this trend switch. We thought this would occur. Correct. We definitely thought there would be sellers here. Incorrect. Okay, let's just be real. This is where, of course, I think options were a good scenario towards the short side. However, it didn't actually get a small time frame switch. The small time frame switch happened there. Now we also have now a high, a low, a high, a break to an upside. So that could be a false break ? And then we have a lower low. So if we get a pullback during the news, let's say this 4160 to 4150 zone somewhere in here, the initial reaction may be initially up. Then if you're in here, could you provide yourself a short opportunity? Well, yes, you could, but you got to risk manage it. Obviously, the problem with these before have been, and if we go and have a look at another one, this type of thing, where you get the market doing this false break narrative. These are days where instrument selection is very important. Unfortunately, options are more expensive, but maybe they're the better instrument because you can get these false breaks. So I think from a bear perspective, you're probably looking at the initial reaction, ideally being the bullish side, pushing into here and, providing kind of like a potential risk reward towards the sell side where the initial reaction is wrong. Now, if you're thinking about those hedges, so this is all that FOMC structural hedge of the S&P 500 leading in, to unwind those, if the market goes initially negative, there's a good chance actually there will be an unwind of those hedges by big players. And that's what you've got to be most careful of. Now, where is the key level? Well, unfortunately, it kind of still sits around that 40.68. So maybe a spike underneath that, then a rally. If that rally then boosts to a new high, well, we're going to squeeze. And the next squeeze level is 4,300, 4,350 in my opinion. So if the initial reaction is down, then we squeeze. It's probably going to keep squeezing for a few sessions, move into that high, make people lose their minds. And at this point, I think there's extreme bears sitting. However, that's one of the scenarios. We've got that kind of initial reaction up, initial reaction down, both being, in that case, the false move. Now, it is possible the Fed come out and do some kind of really radical thing to freak everyone else and we just get a watershed moment. It's unlikely. It hasn't usually happened that way. But I guess, we'll talk about everything because we want to do it. Daily close here, not significant enough. It didn't close on its lows, so it doesn't really show you that there's strong bears out there. It could even be a day where you want to be neutral and just wait and be patient for this level to change. A lot of people are super frustrated here. I understand why. It's basically been sitting, actually, we can look here and let's do the weekly. So if we go to the weekly, it's 1, 2, 3, 4, 5 weeks. So people have gotten used to some pretty large moves. 5 weeks of effectively some form of either accumulation or distribution being formed is frustrating when you're used to fast moving markets. So that's the frustration. If you prefer, you have to wait for the breakouts and then see which side you believe it's on. And it's all going to be reactions around these lows and highs. If we initially come up and even if we spike it and then go back down and then we end up bearish, there'll be more follow through. There wouldn't just be one. If that happens, it'd just be like that other time where we saw it, which is over here. Steal everyone's stop losses, put the sad face on everybody, and then push down for a few sessions. Remember, that's a weekly, so it pushes down for a while there. If it does the bottom, then of course, instantly starts rejecting back up, it's going to squeeze that zone. At least that's the two ways I'm looking at it. Hopefully that's helpful. If we look at the options here, you can see that there's been a bit of an unwind of some of the options. I think these numbers are a little bit lower. It's not a huge options week, but overall, we've got 400 puts, 405s, 415s, and 425s. So on that top end scale of 422 or 4217 or whatever, we basically have a bunch of calls sitting there kind of blocking it. And of course, we've got puts blocking the bottom end. It could be a non-event. I think it should be volatile this week, but the VIX obviously has spiked for that reason. What about Bitcoin? Well, it hit our most traded zone. You can see where the daily closed right on it. Then we saw some buyers. I think it's neutralized within two zones. Overall, though, if I looked at this on the surface and I had to pick direction, I'd be bullish here, purely because we got that new high, and I'd say it's something like this leading into that zone. So be careful in Bitcoin, but look, it came back to our most traded level. It found buyers. It found them. It pushed past this block here of supply. So you've got to kind of think that, well, as a day trader, that would be your statistics overall, at least the way I would look at it. If you're interested in knowing the times for everything, here are the times. ADP non-farm employment change coming out at 8:15 a.m. 10 a.m. we've got ISM services PMI. Then we have the FOMC statement and the funds rate. Remember, the difference between the statement and the press conference is the key. Often this is where the false reaction lies, and then we see the real reaction during the press conference where Jerome says mad things, and then the markets go off in opposite directions and all sorts of things. If we're going through the news for the week, then we still have non-farm payrolls, 8:30 a.m. on Friday, so definitely check that out. And of course, if you're interested in following us on some of the other socials, definitely check us out. You can also get 3 free trading cheat sheets and come and join some other areas of the community. I hope you found value in today's video. If you did, It's the best community here, so make sure to subscribe. I want to say a big thank you to everybody that wished me well with the birth of my son over the last month. I really appreciate it. There's too many messages coming in for me to respond to everybody, but I did want to say thank you. And look, we're back in a routine and everything, so I think the content's only going to get better. It was definitely tough running it, but I am committed to the channel. I'm committed to you guys, and I hope that we can really get even better content in the future. So yeah, I'm going to bring in more. I'm getting a whole bunch of other stuff, and believe me, there's some big stuff coming for this channel. So I'm really excited to hopefully announce that very soon. Let's just say it'll be some exceptional reports. All right, bye for now. See ya.